Welcome back. Let's talk about the markets. We have been struggling over the last couple of days, but today there is a relief rally and we're holding up with a gain of close to about 0.4%. Prateek Parekh, the equity strategist at Nuvama Group, is now joining in to discuss the way forward. Prateek, even if there is no risk right now or a minimal probability of a large-scale systemic bank collapsing either in US or Europe, which could result in a long and deep recession, the truth is these large US banks and European banks are going to turn a bit cautious. Some of them said that, even the mid-regional banks are freezing on their lending, and what we could have on our hands is a slowdown, an accelerated slowdown compared to what the market was penciling in. Does this pose big growth risks for the Indian market? Because the narrative up until now is that Indian markets will continue to see good growth in FY24, and therefore once this volatility ebbs, Indian markets will pick up in the second half of the trade. But is there a risk to that growth estimate, this EPS pickup estimate for the Indian markets for FY24?
Hi Rima. Thanks for having me over. I think if you look at it, right, the current fallout or the current crisis that we are having, this time around, it is more of a duration or interest rate risk rather than a lending or a credit risk that we had during GFC. So to that extent, I think the chances or the magnitude of the problem is significantly lower this time versus what we have had in the past. This problem can be very quickly fixed by cutting interest rates, and to that extent, at least that gives some comfort. But nonetheless, Rima, as you rightly said, I think the growth outlook is where the challenge is a bit more, especially from a very near-term perspective. If you look at it, even before SVB fallout happened, the monetary setup globally was not very conducive. Yield curves had flattened very sharply. You had one of the deepest inversion in yield curve. You had global money supply growth slowing down very sharply. And all these things are not very conducive from a growth outlook perspective. So to that extent, this event only accelerates the near-term growth outlook. Now, if I look at the transmission of these global events to Indian markets or Indian earnings, the transmission typically happens through three channels. One is the exports channel, which is your IT services, your pharma, your chemical company sales. Second is your prices or commodity price earnings channel. And the third is the liquidity channel. Now, typically, all these three work together. But this time, there are a lot of leads and lags. If you look at last year we had IT stocks correcting very sharply because there are concerns on the growth outlook as well as margins which are weakening. So to some extent, the trade part of it has been priced in the markets. Commodity companies, have had a bad start to the year so far. This is despite China's unlocking. So prices for also things have been priced in. But what has been the real laggard this time on the liquidity channel? Last year, despite the whole global sell-off in asset prices, you had Indian financials and Indian cyclicals like capital goods doing very good. This is a historical anomaly. And the simple reason for that was, well, globally, Fed and central banks were tightening and so was RBI. The domestic financial conditions were still very benign. You had lagged the banking sector liquidity still in surplus. And to that extent, the pain of tightening was not yet felt. But if I look at it now, the LAF surplus has vanished. India's very own yield curve, which is a very good proxy for banking profits, has flattened. And also, we are now seeing signs of consumption slowdown. So to that extent, I think the growth outlook certainly does look a bit more worrisome from FY24 perspective. So to that extent, we do remain cautious, even if there are no further fallouts. But having said that, I would like to mention that unlike the past crisis, where once we have entered crisis, we have taken a lot of time to come back. We have had scarring, for example, post GFC when you had European debt crisis, we had corporate sector, the whole NPL cycle unraveling. After ILFS, the NBFC crisis, it took a lot of time to fix. This time around, domestically at least, you have the banking system balance sheets very strong, and also the corporate balance sheets being very strong. So once we are on the other side of the recovery, I think the recovery should be much quicker and the scarring of the economy should not be there so much this time per se. So yes, overall, I think from a growth outlook perspective, it does warrant some caution per se.
Good, you mentioned the positive as well, Prateek. We've been getting so much of negative news, right? But you have to say it like it is. I completely get that. So in light of that analysis, tell us how your portfolio is positioned right now. Are you being a little more defensive in nature? And also, the third quarter anyway gave us an indication that corporate earnings aren't running away in a hurry. We saw some downgrades. Do you see that accelerating Q4 onwards? And what is the earnings estimate FY24 that you're working with at least right now?
Yeah. So if you look at the FY24 estimates, consensus is forecasting anywhere between 15 to 18% growth. We do see some downside risk over there. And from a portfolio perspective, our main philosophy is that if you look at 2022 or FY23, the concern on earnings was on the margins front. Because of your rising input prices, IT companies were hiring big time. So to that extent, it was the margins that really shook the earnings. But as we move to CY23 or FY24, I think the main earnings pain point potentially can be on the demand part. I think the top line, the key drivers, which is exports, prices, and liquidity, are all turning adverse. So I think from a next year perspective, on the earnings part, you will see demand slowing down. So from a portfolio construct perspective, our philosophy is to buy into sectors where the demand risks are very low, and also sectors which will benefit from falling input prices. And finally, in an environment where liquidity is tightening, we would stick with the ultra defensive portfolio and would avoid companies with any leverage of sorts per se. So in such context, we are overweight staples, we are overweight cement, where we think, with falling input prices, the profitability should come up. We are overweight, insurance as well, despite what has happened in the budget. And also we are overweight IT, where while there are concerns on the global front, but our main thesis is that in IT, unlike past, margins are likely to do better. And finally, IT being a cash-rich sector, typically outperforms during all global recessions. So to that extent, we are overweight that, and we are underweight all the cyclicals, whether it's domestic or global, because our belief is that the current slowdown is broadening. At least so from a cyclical perspective, we are very defensive, and we have underweights in financials, industrials, even durables, where we think the valuations are very high, and with demand slowing down, there is some caution that is warranted per se.
All right, Prateek, you're sounding extremely cautious, but one space I want to ask you about, because we have been talking a lot about this, is what's going on with real estate, right? It's so mixed in terms of the fact that luxury sales seem to really be going through the roof. There's no sort of problem with demand, at least that's what it looks like right now. But on the other hand, maybe the affordable segment is not really, quite there yet. Is this something that you think is worth looking at in terms of just an investment perspective, the real estate stocks?
Yeah, again, great question. So I think real estate stocks are one of the deeper cyclicals per se. They are one of the early cyclicals as well. So I think when the tide turns and we have deep rate cuts, real estate stocks will turn attractive. But at the current juncture, we would remain cautious on some of the real estate names as well, because as you rightly said, that this time real estate recovery has been two-track, where we had luxury sales doing very good, but the affordable segment not doing so well. Going ahead, with the concerns on layoffs in the tech sector, so on and so forth, and interest rates rising very sharply, even the luxury space, there's a risk can see a slowdown. So to that extent, I think from a demand perspective, real estate can face some headwinds. And given the deep cyclicality over here, some moderation in prices, some moderation in demand, the whole valuations and all those framework can change very quickly. So that's why on the real estate front, while the longer term outlook is great, where the excess supply has been cleaned out, there has been a reasonable amount of consolidation, and for 10 years, the cycle hasn't been there per se. So while from a longer term, it's very great, but I think from a near term perspective, which is over the next 6 to 12 months, caution is warranted on the real estate space per se, because we still think that, things are not completely out of woods, and here they are staring at a slowdown going ahead over here.
Prateek, that point about, the tech layoffs possibly hurting real estate is quite true. So many companies we've chatted with, off the record seem to indicate that in FY24, IT companies are going to moderate their wage bill after the extraordinary 2 years in terms of promotion and wages. So salaries are going to come down, and plus, of course, layoffs are there. So maybe, Bangalore real estate could get a bit of, hit, because if growth is slowing down for the IT companies, margin lever is something that they will look to flex, and that's going to be done with the attrition coming down. It's going to be done via that wage bill number. But thank you very much, Prateek, for joining in. We'll slip into a break. On the other side, we'll get you more on the markets.